can you please explain what is the damage that it's causing? And how do these liquidation cascades work? And what we've kind of touched on this already, but what is their net impact on price? Like what's mechanically happening
Yeah.
in the system and then to the price?
Yeah. Well, we talked about the damage in terms of the price, that it suppresses the price,
Yeah.
especially the blow off top. It cut off the top, so to speak. And we never saw it because there was so much price suppression happening with all of the fake supply satisfying real demand. But it exacerbates it on the downside too, because now no one knows just how much selling pressure is going to be coming. And so no one wants to catch the falling knife. And it's tough when you get these liquidation cascades because you don't really know where the bottom is. But the hodlers, we've seen all this before, like, in March 2020, we just, if you're not leveraged, you're just saying, all right, my mark to market went down, but I wasn't going to sell anyway. So, okay. I've been through these cycles
today.
before.
Yeah.
Good for you.
If you sit on some dry powder, you can be opportunistic. So it was great.
That's yeah. Well, but your point is well taken, because the volatility that comes, that is the damage that's been created. It actually doesn't give the good volatility, right? It cut the top off, but there's worse volatility on the downside. And so the impact of that is that it definitely picks people's pockets. And it increases the cost of capital for the intermediaries in the sector. What am I getting at here? For the finance folks who are listening, you'll understand it. My reference to the capital asset pricing model. Again, it's not a perfect model, but the volatility of the underlying, if it goes up, the cost of equity goes up for everyone in the industry. And therefore, the capital becomes higher, more expensive for everyone in the industry to finance. And therefore, they have to charge you more in the service fees that they charge you. So that's another indirect way that there's been a lot of damage from all of this leverage. The circulation credit type leverage that has hit this industry. It's making everybody have to charge more because they've got to cover their higher cost of capital. It's a hardcore finance concept, but it does play out in reality, because if those exchanges or intermediaries are trying to raise money, they're going to be raising less money at a lower valuation, and that's because their cost of capital is higher.
Yeah, it's just basically injecting more uncertainty into the marketplace, so capital gets more expensive.
Exactly. That's a simple way to say it, and that's exactly what it ultimately is. I gave you the fancy way to say it, but everyone understands that anytime something's more uncertain, they want to be compensated for the higher risk.
Of course.
So, and when you make the volatility higher, especially if it's asymmetric, where it's worse on the downside and you don't get as much upside, then of course it's not good for all the industry.
Yeah, no, beautifully said. I've been forced to I used to view the broad crypto asset space as something like liquid venture capital, and then Bitcoin is something fundamentally different, more like the internet itself. But I'm increasingly feeling called to reevaluate my position that this space that I thought I was analogizing to liquid venture capital is much more scammy than I thought it was. I knew there was a lot of junk out there, but man, I struggle to find anything that's not scammy lately. So do you think, and this, maybe I was influenced by books I read earlier on when I got into the space, like, the titles will escape me now. The Age of Cryptocurrency, and they wrote a sequel book. They went into deep theory about blockchain and distributed consensus, all this stuff.
Yeah, sitting on my shelf. In fact, there it is. I'm looking at it right now.
Do you think that there are other viable, even if theoretical, use cases for alternative crypto assets or blockchains or distributed consensus technologies other than money?
Yeah.
Or how have your views, what are your views now, and how have they changed over time?
That's a great question, because it ultimately is the question behind Bitcoin maximalism. And I think you and I both consider ourselves to be maxis. I always like to say I'm a long-term maxi. I support the innovation in true technology innovation. To your point, a lot of what we're seeing is just scams. It's the old scams wrapped up in new costumes.
Right.
But there is some serious new technology out there, and I tend to migrate towards those that are seriously making contributions in the distributed systems and cryptography areas of the world. Bitcoin is still the one, in my view, that is decentralized and is secure. But I also definitely think that there's room for blockchains. It tends to be in shared infrastructure. So one of the things I did when I was at my enterprise startup, my prior company called Symbiont, that was a company you may have come across, well, maybe not. Adam Krellenstein was one of the earlier Bitcoin core developers, and he was credited with creating what is, I think CoinDesk gives him credit for co-creating the first altcoin called Counterparty, which is a layer 2 coin. Tatiana issued Tatiana coin on Counterparty. It was the first experiment to try to create smart contracts in Bitcoin, and I believe it was 2014. So it was quite a while ago. And Adam was a CTO of Symbiont, and Symbiont built a proprietary system that didn't have a token. Okay, so what's the use of a smart contract system for a token? Well, I helped deploy that. I was around for the pilot project. It is now publicly disclosed that it's in production at Vanguard. And what is Vanguard doing? It's shared infrastructure for data, where it was really critical for all the users of market index data to be able to prove with a clear audit trail that they got the market index data from their index provider at a particular point in time, and to be able to get that data to the portfolio managers, because in that market, any tracking error is potentially a real problem, because just tiny tracking errors end up causing potentially huge losses in index fund assets, if the tracking error is higher, especially if it's consistently higher than competing funds, right? So getting the index data to the portfolio managers, ingesting it, updating it, and then making sure that everybody who's using it is using the same data. That's actually a pretty good use case. It's funny that you asked this question, because I was just thinking the other day, Adam taught me so much about database architecture. And again, we're leaving the scammy part aside. Some of these database architectures, many of them don't need tokens. And but if they get too distributed, right, these are quasi-centralized, which means they're not decentralized. But if they get too distributed, then you start to get the DDoS problem, you start to get the spam problem that Dr. Adam Back has spent his whole career thinking about. So that kind of conversation, there are database architectures that absolutely work for shared distributed systems that run smart contracts in the shared infrastructure context, but there's no token. So, we don't hear very much about Hyperledger. That was the big thing back in, 2015, 2016. IBM curated that as a public blockchain that was open source, but it was permissioned. So it really, truly wasn't public. It was more of there are different federated versions of these. And these are walled gardens. These are clubs. You've got to get into the club, and everyone knows who's in the club. Okay, but that's not Bitcoin. And that's so different than Bitcoin. And have I seen that those use cases absolutely make sense for that kind of shared infrastructure? Yep, I have. Does it mean that there has to be a gas fee with it in the form of a token? Not necessarily. But yes, I mean, I look at a lot of these technologies and shake my head at the scams that are being used, but there's real experimentation with technology out there as well. And I'm not as quick to dismiss that. I just wish that they didn't have tokens. And in a lot of cases, they don't need them. But if they have a token and they don't need it, then you should be asking yourself why.
Right.
Is that really just because they want to pull the proverbial pump and dump? And then also, you mentioned the VCs. I think all of us woke up over the last year to the game that was being played with pre-mines, with the VCs getting coins at a discount, and then they realized their profit on the token distribution event. And in the VC world, they used to have to wait 5, 6, 7 years for returns.
Yeah.
And now they were shortening the duration of their business, turning their inventory a lot faster if they could get to the, if they could get a realization event within the first year. That is not the venture capital business. That's
Right.
trading business.
Yeah.
And boy, a lot wasn't disclosed in terms of that. The SEC could have been far more aggressive in enforcement actions than it was during all that.
Yeah. It's interesting how much that their business model just was accelerated. And I don't know, it was interesting to see traditional venture capital and this weird crypto ICO thing sort of merge over the past few years
Yes.
in many ways.
Yeah.